Welcome back to our Investing 101 series. Today, we take an in-depth look at one of the most significant benchmarks in the financial world, the S&P 500. This index is not just a measure of the U.S. stock market. It's a critical tool for investors seeking long-term growth through diversification and stability. We'll explore what the S&P 500 is, how it functions, and why it's a cornerstone for anyone serious about building wealth over time. We'll also discuss strategies for leveraging this index in your investment portfolio, including dollar cost averaging, to maximize your returns while minimizing risk. The S&P 500, short for Standard & Poor's 500, is an index that tracks the performance of 500 of the largest publicly traded companies in the United States. It is widely regarded as one of the best representations of the U.S. stock market and the broader economy. The index includes companies from various sectors, such as technology, healthcare, financials, and consumer goods, making it a comprehensive snapshot of market performance. Unlike other indices, the S&P 500 is market capitalization weighted, meaning that larger companies have a greater impact on the index's performance. Investing in the S&P 500 offers several advantages. First and foremost is diversification. By holding a broad basket of stocks across multiple sectors, the index reduces the risk associated with investing in individual stocks. This diversification is crucial because it spreads risk across many companies, reducing the impact of poor performance by any single stock. Additionally, the S&P 500 has historically delivered consistent returns over the long term, making it an attractive option for investors looking to build wealth steadily. The index's average annual return has been approximately 10% since its inception, though this can vary year to year. One of the key characteristics of the S&P 500 is its inclusion of established blue-chip companies that are leaders in their industries. These companies typically have strong financials, stable earnings, and a track record of dividend payments, which contribute to the index's overall stability. For investors, this means exposure to some of the most reliable and resilient companies in the world. However, it's important to remember that even the S&P 500 is not immune to market volatility. The index can experience significant fluctuations, particularly during periods of economic uncertainty or market downturns. For many investors, the S&P 500 serves as the foundation of a well-diversified portfolio. It can be accessed through various investment vehicles, including mutual funds, exchange-traded funds, ETFs, and index funds, which replicate the performance of the index. These products offer an easy and cost-effective way to invest in the S&P 500, with low expense ratios and broad market exposure. This accessibility makes the S&P 500 a popular choice for both novice and experienced investors who want to benefit from the long-term growth potential of the U.S. stock market. One of the most effective strategies for investing in the S&P 500 is dollar cost averaging, DCA. Dollar cost averaging involves regularly investing a fixed amount of money into the market, regardless of the current price levels. This strategy takes advantage of market volatility by buying more shares when prices are low and fewer shares when prices are high. Over time, this approach can lower the average cost per share and reduce the impact of market fluctuations on your portfolio. Dollar cost averaging is particularly beneficial for long-term investors who are focused on building wealth steadily and consistently. Reinvesting dividends is another powerful strategy for maximizing returns when investing in the S&P 500. Many of the companies in the index pay dividends, which are portions of their profits distributed to shareholders. By reinvesting these dividends back into the index, Investors can take advantage of compound growth, where earnings on dividends generate their own earnings over time. This compounding effect can significantly boost overall returns, especially when applied consistently over many years. While the S&P 500 offers broad market exposure, it's essential to maintain a balanced investment strategy. This means complementing your S&P 500 investments with other asset classes, such as bonds, real estate, and international equities, to further diversify your portfolio. Diversification across asset classes can help manage risk, particularly during periods of market volatility when different asset classes may perform differently. By maintaining a diversified portfolio, you can reduce the impact of any single investment's poor performance on your overall returns and increase your portfolio's resilience to market fluctuations. Investors should also consider the role of rebalancing in managing their S&P 500 investments. Rebalancing involves periodically adjusting your portfolio to maintain your desired asset allocation. For example, if your S&P 500 holdings grow significantly and begin to represent a larger portion of your portfolio than intended, you might sell some of your S&P 500 shares and reinvest the proceeds into other asset classes to restore balance. Rebalancing helps ensure that your portfolio remains aligned with your investment goals and risk tolerance, while also locking in gains from outperforming assets. The S&P 500 is often used as a benchmark for evaluating the performance of individual stocks and investment portfolios. When assessing your portfolio's performance, comparing it to the S&P 500 can provide valuable insights into how well your investments are doing relative to the broader market. If your portfolio consistently underperforms the S&P 500, it may be time to reassess your investment strategy and consider adjustments. Conversely, if your portfolio outperforms the index, it's important to understand the reasons behind the success and ensure that the performance is sustainable over the long term. Another critical aspect of investing in the S&P 500 is understanding its composition and how changes in the index can affect your investments. The S&P 500 is not static. It is regularly updated to reflect changes in the market. Companies may be added or removed from the index based on factors such as market capitalization, financial health, and sector representation. These changes can impact the performance of the index and, consequently, the value of your investments. Staying informed about the composition of the S&P 500 and any upcoming changes can help you make informed decisions and adjust your portfolio as needed. The S&P 500 is also influenced by broader economic trends and global events. Factors such as interest rates, inflation, and geopolitical developments can have significant effects on the performance of the index. For example, rising interest rates may lead to lower stock prices as borrowing costs increase for companies, while geopolitical tensions could cause market uncertainty and volatility. Understanding how these macroeconomic factors influence the S&P 500 is crucial for making informed investment decisions and navigating potential risks. Finally, it's essential to have a long-term perspective when investing in the S&P 500. While short-term market fluctuations can be unsettling, the S&P 500 has historically shown resilience and the ability to recover from downturns. By maintaining a long-term focus and avoiding the temptation to react to short-term market movements, you can benefit from the consistent growth that the S&P 500 has provided over time. Patience and discipline are key to achieving success as an investor in the S&P 500. And staying committed to your investment strategy can help you achieve your financial goals. The S&P 500 is a cornerstone of modern investing, offering a balanced mix of stability and growth through its diversified exposure to leading U.S. companies. By understanding how to leverage the S&P 500 in your investment strategy, you can build a robust portfolio that stands the test of time. Whether through dollar cost averaging, dividend reinvestment, or strategic diversification, the S&P 500 provides numerous opportunities for long-term wealth creation. As you continue your investing journey, remember that success with the S&P 500 requires patience, discipline, and a commitment to staying informed about market trends and economic conditions.